Thank you for having me. Oh, what was start? Yeah, that's all. Right. Hey. Can you hear me now? All right. Okay. Following Neil's presentation, he said to me, introduce yourself and make sure that everyone knows who you are, because you don't look like a stockbroker. There we are. Thank you. Do you want to sort out the slides? Hold on.
It's going into presentation mode.
Yeah, just need to view. Can you make it one page, please?
In my contracts, I always have to have the IT guy there.
One page. Okay, while we're waiting, let me explain. I'm the CEO of Business Consultants International. It's a research and strategy house. I've been a stockbroker since 1990. I've completed dozens of projects on listings companies. I'm also an associate to, I'm also the CEO of eVista, BCI Venture Capital. I sit on the board of Anglo Special Projects. We got it? And I'm an associate to Arbor Capital, Merchant Tech Capital. I sit on Coltech's board to do all their economic analysis of chemical products. I've listed dozens of companies. I've written 12 financial books. The ones in red are university textbooks. All right. Today I want to talk about listing properties and property company. But before I do that, all this experience, all of it that I have had since 1990, has identified two basic factors. The first one is that stockbrokers complicate things to the extreme. And the second one is that successful entrepreneurs are ones with an inner strength that will never stop them doing anything. My strength is identifying those entrepreneurs who have that inner strength. All right, first one, how do we list the company on the exchange? And stockbrokers will tell you it's a 2-year process, blah, blah, blah. It's really, really very simple. All they're trying to do is obtain enough research to identify what investor sentiment will be towards your company, and if they take your earnings per share, multiply it by a fair ratio, which is your investor sentiment, you get a share price. It's as simple as that. What they try and do, I'm not very creative, I'm a stockbroker. Right. All right. What they try to identify is two things. Firstly, research, and that research identifies what investor sentiment will be towards your company. And secondly, and in all honesty, the real aim is how much they're going to get paid out of the process of listing your company. So, which reminds me of a story 2 years ago. This American entrepreneur asked me that very question. He said, if I give over my business to you to list, can you do the research? So I said, well, I've been doing it since 1990. So they said, oh, by the way, we can only pay you at risk. So I said to him, I'm Sicilian, payment is never a risk. He paid up front. Right, so we're going to concentrate on just two things today because I've only got half an hour, I could talk all day. How we list and why should we list. How we list, this is the process. First, the stockbroker will say, okay, we need to do research, global research. Let's identify international best practice so that when we do due diligence on your company, we take it apart, bit by bit, and we rebuild your company based on international best practice. And we start with a shareholding, we go into the board of directors. Do you meet King 3? Do you have, when you Companies Act King 3, do you meet all the requirements of having a proper structured board? Do you have all the subcommittees, audit committees, the audit committee, the remuneration committee, and communication committee? Do you have any of those? 90% of entrepreneurs don't even know what King 3 is. So what we do is we do due diligence, research. We then put the company together through a set of workshops that identify operational and financial strategies. And again, the whole idea is to be able to draft a business plan for AltX, because AltX requires it as part of Schedule 21 of the Listing Requirements Act. So you have a business plan that fulfills all the criteria of King 3 New Companies Act and Schedule. And that is to enable the AltX committee to say, based on your business plan, you may list without conditions, whatever they decide. The only way you can do that and get a yes within the first hour after presenting to the AltX committee is to enable to persuade the committee that your financial forecasts are based on a set of assumptions which are qualified by research. It's as simple as that. Now, let's look at why we would list. Why would you list? It's a simple matter. Tons of cash. That's why you would list. Your fair value, and I'll take you through some basic calculations. Why you would list. Stockbrokers say a simple thing. You list a company to multiply that investor sentiment towards your company. A private company has very little investor sentiment. Nobody knows you, or very few people know you. When you become part of the market, whether on AltX main board, international exchanges, doesn't really matter. You suddenly become the focus of the international community. And suddenly your investors are multiple, hundreds of thousands, people all around the world, and the value of your company increases. Before I get into the calculations, I've been asked the question in Joburg, surely there must be a reason why you would list under these market conditions. You think about the market reaching new highs almost every week. Why would you list now? Two reasons. The first is that international funds flowing into the JSE have increased from last year's 1 billion rand per day to over 2 billion rand today, per day. So you have to ask yourself, where's this money coming from? And is it important that these funds are coming into South Africa? Well, if you break down that 2 billion rand per day trading, or value of trades on the JSE, and you'll find that only 30% is local trade. 70% of that money is coming from international markets. And again, why should they be focusing on South Africa? Well, because international fund managers who control $1 trillion of funds around the world, $1 trillion in emerging markets, let me qualify that, in emerging markets. In 1997, followed by the 2008-2009 market disasters, decided that in their wisdom, they had 80% of those funds, of $1 trillion, based in Asia and South America. And after this market disaster, they decided to restructure that and place only 50% in South America and Asia, and then the remainder 50% in former Eastern Bloc countries and Africa. You have to ask yourself what's happening in former Eastern Bloc countries. Disaster, you have Russia's sanctions against the country, etc., etc. In Africa, you have Egypt, Libya, disasters, Nigeria, another disaster. And so there are few countries for these international fund investors to invest in. Remember, there's 30% of $1 trillion coming into South Africa. Our markets will continue to rise. That's the first reason. And the second reason is entrepreneurs tend to look at the economy to determine where the JSE is going. It's actually the other way around. The JSE is the leading indicator of where the economy is going. And if the JSE keeps rising and rising and rising, there will be a time when it will correct. Stockbrokers never use the word crash, ever. Because in 1987, it took 2 years for the market to recoup after the crash. In 1997, it took 3 months. 2008, 2009, it took less than 3 weeks. So the market's correct. Listing your business today will get you the highest value possible. And we take this example. Take a simple example of a property owner who has 1,000 square meters. So occupational rent is 80%, property is 80% occupied, it charges 500 rand square meter, and the building price is 1,000 rand per square meter. Right. Before we get to the calculations, these are the statistics that stockbrokers use when looking at property companies. These are 7-year averages. And you look at this, and this is standard. All brokers will use it, and they'll say, you fit within this profile. Again, stockbrokers are very narrow-minded. They don't look outside the box. So they say, if your net profit margin is 28%, your rental rate is 37%, and your cash flow per share is 1%. That means, cash flow per share means for every rand that the company achieves in cash flow equals to 1 rand in share price. Right. So now we start with the absolute basics, and you look at this and you say, okay, so you want to sell your building today, and it is 0 occupied. What would you get for it? Well, it's simple. 1,000 square meters, 1,000 rand. Company's worth 1 million rand, right? Simple. Nobody would want to sell their building today at 1 million rand, even that kind of small building. But we take it further and we say, well, what happens if you're willing to wait 1 year? And remember, 30% occupational rate, according to the stockbrokers. I'm saying, well, let's look at 80%. 80%, 500, years 1, 28% net profit percentage to turnover or to rental gives you 1.3 million rand value. Now, stockbrokers look at it 2.5 times PE. So that's it. You've got 1 million rand value plus your rental gives you a 2.3 million rand value of the building today, after 1 year. So you've gone from simply 1 million rand value of the building to 2.3 million. Stockbrokers are not interested in that. I mean, who cares if you have occupational rent for 1 year? They want to look at the long-term picture. So what they say, if we do a 12-year, this is value based on earnings, discounted cash flow over 12 years, what they're really doing is this, to put it bluntly. They're saying, we will own shares in your property company, not really care about you right now, just what we're going to earn out of this. If we look at a 12-year picture, what is the company going to be worth? Even though we're not going to pay you that. Because we're only going to look at 2 years, 3 years, 4 years maybe. Certainly not 12 years. So if you look at this 12 years, this is the value of the company. Same company. Therefore, profit, 60 million rand after 12 years. You've looked at the fair value on a 2.5 times P ratio. In other words, they're saying, this value over 12 years multiplied by a simple 2.5 times PE, price earnings ratio, gives you a value of 40 million. This is behind the scenes calculations. Entrepreneurs don't get to see this. Because what they do is this. You should be so lucky to get 40 million. Right. We look at a 2.5 times PE, gives you that same value, times 3 years, times the value of the price earnings, gives you 6.7 million. So that's what the entrepreneur gets to know. He says, my property's worth 1 million rand. If I don't list and I sell it as an unlisted company, this is the value, 6.7 million. The stockbroker says 2.5 times P ratio is pretty much the standard ratio for an unlisted company. We can push that up multiple times if we list your business. So how do stockbrokers determine a share price? There are 3 ways: auction, book building, and fixed price. These are the 3 ways that stockbrokers around the world determine a fair share price. Remember, share price equals a fair price earnings ratio multiplied by your earnings per share. It's a simple ratio. The higher the P ratio, your earnings per share doesn't change. The higher the P ratio, the higher the share price. Right? Simple calculation. What happens with auction is that the stockbroker will take your business, he's created or formulated a prospectus, he sends it out to the institutions, to the retail brokers, and he says, auction the share price. By a certain date, we will have the highest price and the lowest price combined together to get a middle price, which will be the listing price. Right? They take the lowest and the highest, merge it, get an average, that will be your price. Book building is they will send out the prospectus and they will take a cross range of share prices. I'll say, well, if you build this book to achieve Schedule 21, which states that 10% of your shares has to be placed in the hands of 100 shareholders, Alt X regulations. Then you need to have a share price. Book building simply enables you to quantify and assess market sentiment towards your company. Fixed price is when they say, who cares what the market thinks? We'll put it at a fixed price. So using those ratios, I know this is difficult to see, but I'll take you through it quite quickly. Using the ratios as that first page, what happens is this. They say 17.98 or 18 times PE is the market ratio. The total market of the JSE, that's the PE ratio. Remember, 2.5 times PE equals an unlisted company. Now, the market's 18 times, property is on 15 times. So let's get a median between the two, and you end up with an average PE of 8.1 times, a minimum value of 12 million, maximum value of 18 million on 15 times. And my question is, which would you choose? Today's value, R1 million, 1 year's earnings, 2.3 million. Wait for an unlisted 2-year view, 6.7. List the company now, 18 million. Remember, the value without being told to the entrepreneur is 40 million. Same company. The question is, which would you choose? I can tell you, and as a parting note, I've been asked repeatedly, well, there are so many property companies listed. Why would you list another one? It reminds me of a communist friend of mine, and that sounds strange. But his name's Don, and he says to me, I asked him, Don, you've been a communist all your life. What would you want? If I can give you anything today, what would you want? And he said, a Mercedes-Benz. So I said, well, Don, communism is about the people, not you. So I said, well, I'd want everybody to have Mercedes-Benz. So, well, how are you going to achieve that? And he says, one at a time. So I said, oh, the starting point of one at a time is you. He says, now you get it. That's how you list properties, one at a time. Thank you. Any questions? I have 4 copies of my Alt X book. Anyone want?
I'm going to ask you to do 2 on each side, sir.
2 on each side.
Because the guys on the left here, they, giving it to a left winger, I mean, really.
I'm a rightist, so...
Thank you very much, Jacques.